Right now, as you watch this, your money is disappearing. Not through theft, not through fraud, but through a silent, deliberate process that operates in plain sight. Every dollar you have saved, every euro tucked away for retirement is quietly losing its purchasing power. This is not a conspiracy theory. This is monetary policy. Governments around the world have been waging a hidden war on your wealth for over a century. They do not need to confiscate your savings directly. They simply make those savings worth less with each passing year. The question is not whether this is happening. The evidence is overwhelming. The question is, what are you going to do about it? Welcome to the silent war on your wealth. Unlike conventional warfare, there are no armies, no declarations, no visible battles. This conflict operates through central banks, monetary policy, and the calculated expansion of the money supply. The weapons are abstract: interest rates, quantitative easing, and currency manipulation. Yet the casualties are profoundly real. Ordinary citizens who work hard, save diligently, and plan for the future find their purchasing power steadily eroded. This is not accidental. It is a systematic transfer of wealth from those who hold currency to those who control its creation. Understanding this mechanism is the first step toward protecting what you have earned through years of discipline and sacrifice. This silent war is not a modern invention. Throughout history, governments facing financial pressure have debased their currencies to escape obligations. Ancient Rome clipped coins, reducing their silver content while maintaining face value. Medieval kings recalled currency and reissued it at lower weights. The fundamental principle remains unchanged across millennia. When governments cannot meet their obligations through taxation or borrowing, they simply create more money. The sophistication of the methods has evolved. Today, currency debasement happens through electronic entries rather than metal manipulation. But the outcome is identical. Those holding savings denominated in that currency watch their wealth evaporate. History repeats itself because human nature and political incentives remain constant. You might believe this does not affect you personally. Perhaps you think currency devaluation is an abstract economic concept, relevant only to academics and policymakers. This assumption could not be more dangerous. Consider your retirement savings. Calculate what those funds could purchase 20 years ago versus today. Examine the rising costs of housing, healthcare, and education. The numbers tell an uncomfortable truth. Your purchasing power has declined dramatically, even as the numerical value of your accounts may have grown. This is the insidious nature of inflation. It creates the illusion of growth while delivering the reality of decline. Every person holding currency-denominated assets is a participant in this silent war, whether they recognize it or not. Inflation is the primary weapon in this financial conflict. Economists define it as a general increase in prices, but this definition obscures its true nature. Inflation is not prices rising. It is currency falling. When the money supply expands faster than economic output, each unit of currency commands fewer goods and services. This is not a natural phenomenon like weather or earthquakes. It is a policy choice, made by central bankers and endorsed by governments. They target specific inflation rates, typically around 2% annually. This may sound modest, but compound that rate over decades. After 30 years, your currency has lost nearly half its purchasing power. This is not an accident. It is the intended outcome. How do governments create money? The mechanics are surprisingly straightforward, though deliberately obscured from public understanding. Central banks purchase government bonds using newly created currency. This currency did not exist before the transaction. It was generated through electronic entries, expanding the money supply instantaneously. This process, known as quantitative easing, accelerated dramatically after the 2008 financial crisis and exploded during recent global events. Trillions of dollars, euros, and yen were created in months. Each new unit dilutes the value of existing currency, much like adding water to wine. The bottle appears equally full, but the contents have been fundamentally weakened. Those closest to the new money benefit first, while ordinary savers bear the eventual cost. History provides stark warnings about the consequences of monetary expansion. Consider Weimar Germany in the 1920s, facing crushing war reparations and domestic obligations. The government chose to print money rather than make difficult fiscal decisions. The results were catastrophic. In January 1923, a loaf of bread cost 250 marks. By November, that same loaf required 200 billion marks. Citizens carried wheelbarrows of cash for basic purchases. Lifetime savings became worthless overnight. The psychological trauma extended beyond economics. Faith in institutions collapsed. Social fabric tore. The political vacuum that followed enabled extremist movements to seize power. This was not merely an economic crisis. It was the complete breakdown of societal trust in monetary systems. The aftermath of the Weimar hyperinflation reshaped an entire generation's relationship with money. Those who held traditional savings were devastated. Bank accounts, bonds, and fixed incomes became worthless paper. But those who held tangible assets, what Germans call Sachvermögen, preserved their wealth. Real estate, gold, and productive businesses maintained value while paper currency collapsed. This lesson was seared into the German national consciousness. To this day, Germans maintain deep skepticism toward debt and currency debasement. The Bundesbank, Germany's central bank, historically prioritized price stability above all other objectives. This institutional memory reflects the profound trauma of watching an entire nation's savings evaporate within months. History's lessons are written in human suffering. You might dismiss Weimar as ancient history, irrelevant to modern economies with sophisticated central banks and regulatory frameworks. This complacency is precisely what enables the silent war to continue. Look at Venezuela, where hyperinflation destroyed the bolivar within the past decade. Examine Zimbabwe, where citizens became trillionaires on paper while starving in reality. Consider Argentina's recurring currency crises, or Turkey's recent lira collapse. These are not primitive economies. They are cautionary examples of what happens when monetary expansion exceeds prudent limits. The difference between stable currencies and failed ones is not fundamental. It is merely a matter of degree and timing. Every fiat currency in history has eventually faced this reckoning. None have proven permanently immune. Central banks occupy a peculiar position in modern economies. They are ostensibly independent institutions insulated from political pressure. Yet they consistently pursue policies that benefit governments at the expense of savers. The Federal Reserve, the European Central Bank, and their counterparts worldwide maintain near zero or negative real interest rates for extended periods. This policy punishes those who save and rewards those who borrow. Who is the largest borrower in any economy? The government itself. Central bank policies effectively subsidize government spending while taxing savers through reduced purchasing power. This arrangement is never presented so directly. It is cloaked in technical language about employment mandates, price stability, and economic growth. But examine the outcomes and the pattern becomes unmistakable. Inflation functions as a hidden tax, one that requires no legislative approval and generates no public debate. When governments need revenue, they typically face constraints. Tax increases are politically unpopular and require parliamentary approval. Borrowing eventually encounters market limits as debt accumulates. But inflation offers an alternative. By expanding the money supply, governments effectively extract wealth from currency holders without any visible transaction. No tax collector arrives at your door. No line item appears on your statement. You simply discover that your money purchases less than before. This is taxation through currency debasement. It affects everyone who holds that currency, but falls most heavily on the middle class who cannot access the sophisticated hedging strategies available to the wealthy. Consider the traditional savings account, long promoted as the foundation of responsible financial behavior. You deposit your earnings and the bank pays interest. This appears straightforward and prudent. But examine the mathematics more carefully. If your savings account earns 1% annually while inflation runs at 3%, you are losing 2% in real purchasing power each year. After a decade, your savings have declined by nearly 20% in actual value despite the account balance showing growth. This is the great illusion of nominal versus real returns. The numbers on your statement increase while the goods those numbers can purchase decrease. Banks and governments benefit from this confusion. Informed savers recognize they are running backward on a financial treadmill. Government debt provides crucial context for understanding currency debasement. Most developed nations carry debt levels that would have seemed unthinkable a generation ago. These obligations grow continuously as governments spend beyond their revenue. How can such debts ever be repaid? Through traditional means they likely cannot. Tax increases face political resistance. Spending cuts threaten constituencies. Default would collapse credit markets. But inflation offers a quiet solution. If a government owes $1 trillion in fixed terms and the currency loses half its value, the real burden of that debt is halved. Creditors receive their nominal payments but suffer genuine losses in purchasing power. Savers and bondholders effectively subsidize government spending through this mechanism. Inflation is the politically expedient path of least resistance. Throughout history, those who understood currency dynamics have sought refuge in real assets. Gold has served as a monetary store of value for millennia precisely because governments cannot create it through policy decisions. Real estate provides shelter and utility regardless of currency fluctuations. Productive businesses generate goods and services that maintain value when paper money fails. These tangible assets, Sachvermögen in German financial terminology, represent wealth in its most fundamental form. They are not merely speculative investments. They are insurance against monetary instability. The contrast with paper assets is stark. Stocks, bonds, and savings accounts are denominated in currency. Their real value depends entirely on the integrity of that currency. When that integrity fails, only tangible assets preserve wealth. Why do governments consistently pursue inflationary policies despite the harm to savers? The answer lies in political incentives. Elected officials operate on short time horizons, typically 4 to 6 years. The benefits of monetary expansion appear immediately through increased spending, economic stimulation, and reduced real debt burdens. The costs, however, accumulate gradually and become apparent only over decades. By the time citizens recognize the extent of purchasing power erosion, the responsible politicians have long departed office. This temporal mismatch creates systematic bias toward inflation. Politicians harvest immediate benefits while dispersing long-term costs across the entire population. There is no electoral reward for monetary restraint, but there are immediate penalties for fiscal discipline. The system itself generates inflationary outcomes. The silent war on wealth operates as a massive transfer mechanism. Wealth flows from savers to borrowers, from the financially conservative to the leveraged, from ordinary citizens to those closest to money creation. This transfer is not random. It systematically favors certain groups. Banks receive newly created money first, before it has diluted existing currency. Asset owners see their holdings appreciate in nominal terms. Governments reduce their real debt obligations. Meanwhile, workers find their wages lagging behind rising prices. Retirees on fixed incomes watch their purchasing power decline. Young people struggle to afford housing that appreciates faster than they can save. This is not a neutral economic phenomenon. It is redistribution through monetary policy, operating without democratic consent or transparent accounting. Awareness represents the first defense against the silent war on your wealth. Most citizens remain entirely unaware that their savings are being systematically devalued. They trust that currency maintains stable purchasing power because it always has within their limited experience. They believe that saving money is inherently responsible behavior, without recognizing that the currency itself may be the problem. Understanding monetary mechanics changes this perspective fundamentally. Once you recognize inflation as policy rather than nature, currency debasement as choice rather than inevitability, your entire approach to wealth preservation transforms. Knowledge dispels the illusion that simply saving currency will secure your financial future. This understanding is uncomfortable but essential. Ignorance is not bliss when your life savings are at stake. Protecting your wealth requires strategic thinking about asset allocation. Diversification across asset classes provides the foundation. Consider tangible assets that maintain value regardless of currency fluctuations. Real estate offers utility and historical resilience. Precious metals provide portable, globally recognized stores of value. Productive investments generate returns that can outpace inflation. Examine your current holdings critically. What percentage exists purely as currency or currency-denominated claims? These positions carry hidden risk that traditional analysis often ignores. Reducing overexposure to paper assets is prudent, not speculative. Some maintain emergency reserves in stable foreign currencies, providing geographic diversification. Others explore commodities, collectibles, or productive land. The specific strategy matters less than the underlying principle. Do not trust governments to preserve your purchasing power. Financial education has never been more critical than in our current monetary environment. Schools rarely teach the mechanics of money creation, central banking, or inflation's effects on savings. This gap in public knowledge is not accidental. An informed population would resist policies that quietly transfer their wealth. You must become your own educator in these matters. Study monetary history across different eras and civilizations. Understand how previous currency systems have collapsed and what protected wealth during those transitions. Learn to distinguish between nominal and real returns in all financial calculations. Teach these principles to your children and community. The silent war continues only because most people do not recognize it as warfare. Widespread financial literacy threatens the very foundation of these policies. The silent war on your wealth will continue regardless of your awareness. Central banks will pursue their mandates. Governments will expand their spending. Currencies will be created from nothing. The question is whether you will remain a passive casualty or become an active defender of what you have earned. The choice is yours, but the consequences are inescapable. Every day of inaction, your savings lose ground to deliberate policy choices made by those who will never face the consequences. You now understand what most people never learn. Money is not a fixed measure of value. It is a policy tool that governments manipulate for their benefit. Armed with this knowledge, you can protect your financial future. The war is silent, but your response need not be.